Investing is your ticket to financial freedom. Imagine all of the money in your bank account right now, say $10,000. If the next 20 years are anything like the last 20 years, that $10,000 will need to become $16,400 by 2042, just to be able to buy the same amount of things that you can buy today. That's what's known as inflation, and it's the number one reason why everyone needs to invest. Unfortunately, most investors aren't successful in their endeavors. A recent study found that the average investor has underperformed the stock market as a whole for 25 consecutive years. If investing really is the ticket to financial freedom, then why isn't it working? Simple. Investors are making mistakes, and those mistakes are costing them hundreds of thousands of dollars. Believe it or not, these mistakes are easily avoidable, and as a financial advisor, it pains me whenever I see investing newbies and even experienced investors fall into the same traps over and over again. So to put an end to the 25 consecutive years of underperformance, let's discuss 10 of the most common investing mistakes that beginners are making. Number 1, investing for the wrong reasons. How many people mindlessly threw money at GameStop stock when it was exploding in early 2021? How many did the same for cryptocurrencies like Dogecoin and Shiba Inu? What's the objective of this kind of behavior? Trying to get rich quick. Too many people get caught up in FOMO, fear of missing out, and end up putting their money into investments for no other reason than to follow the crowd. This is not the reason to invest. In fact, it can't even be described as investing. It's gambling. Instead, you want to invest for the right reasons, to build generational wealth, to obtain sustainable financial freedom, and most importantly, to learn. When you invest for the right reasons, you tend to gravitate towards the right investments. So, as a rule of thumb, the next time you see your friends, family, or strangers on the internet rushing to invest their money in something that's being hyped up to be the next big money maker, I want you to run as far as possible in the opposite direction. It might just save you from losses like these. Number 2, not having a long-term investment strategy. Too many people think that investing looks like this, when in reality, it actually looks more like this. Hollywood has created this perception among the non-investing public that the act of investing involves buying and selling stocks very quickly. In turn, that has led many people to believe that that is the correct way to go about investing their money. However, this couldn't be further from the truth. You see, that kind of activity is what's known as day trading. A day trader will try to profit from changes in the price of a given investment over the course of a single day. In other words, they gamble. This is not investing. Investing is the act of making sensible investments over long periods of time that will A, protect the value of the money you originally invested, and B, provide you with a return that at least keeps up with the long-term average inflation rate. To make a long story short, day trading doesn't work, but long-term investing does. It's estimated that 95% of day traders lose money in the market, and the vast majority quit within the first year. So if you want to be an investor, you need to be in it for the long haul, and the long haul is 30 to 40 years. Number 3, neglecting index funds. The index fund is to investors as butter is to bread. Essential. You see, the index fund quite literally allows you to own the entire stock market with one convenient, low-cost investment. You can take 100 of your finest dollars, purchase one single share in an index fund, and by doing so, you will own a small stake in what could be hundreds, if not thousands, of companies. What's my point? My point is that for the 99.99% of you watching, this is all you should be doing. A recent report by S&P Global highlighted that over the past 20 years, more than 95% of actively managed large cap investment funds have underperformed the S&P 500 index. Translation, investment professionals aren't able to successfully pick stocks which over the long term provide better returns than simply owning the entire market. Why would you waste hours of your time researching individual companies to invest in when you have virtually no chance of being successful? Why not instead spend zero time researching, own the entire market, and have the odds of success dramatically in your favor? It's a no-brainer. Number 4, reckless stock picking. For those of you who do want to try your hand at picking individual stocks, it's only acceptable to do so if it makes up a very small percentage of your overall investing activity. I'm talking no more than 10%, and that's only if your investments are well researched and of high quality. So for every $100 you invest, $90 would go towards index funds and the remaining $10 would go towards individual company stocks. And that's That's the maximum. What isn't acceptable is allocating a percentage of your portfolio towards reckless stock picks. What is a reckless stock pick? Examples include investing in a stock just because it pays a high dividend relative to its stock price, aka the yield trap. Investing in a stock just because you read an article about it online. Investing in a stock without being able to explain in 30 seconds why you invested in that stock. If this sounds like too much work, that's because for most of you, it is, which is why you should stick to index funds. As for cryptocurrencies, I don't personally invest in them, and I wouldn't recommend that you do either. Number 5, trying to time the market. There is an old investing adage which says time in the market beats timing the market. In other words, you're better off investing consistently and staying invested through thick and thin rather than trying to sell at the top and buy at the bottom. Reason being, it's simply not possible to do so, or at least to do so consistently for 40 years. Bank of America found that if you were to miss the 10 best days in the market in every decade between 1930 and 2020, your return after 90 years would only be 28%, compared to 17,715% if you stayed invested throughout. Likewise, if you missed the 10 worst days in each decade, your return would be over 3.7 million%. Obviously, neither scenario would ever happen, but the point is that when you try to time the market, which is impossible, you add unwanted variability to your returns. Cut out the BS and stop being greedy, because that's what causes problems. There has never been a single 14-year period since the inception of the S&P 500 where the market lost money, and your chances of losing money over any period of time longer than 7 years is less than 10%. There is literally no reason to do anything else other than buy and hold for decades. So what you do is automate your investments and forget about them, so that every month your money is automatically being invested in the market regardless of what's going on. Zero stress, zero time commitment, zero problems. Number 6, not being tax efficient. A financial decision is said to be tax efficient if the tax outcome is lower than an alternative financial structure that achieves the same end. In other words, you need to be investing in such a way that results in the least amount of tax. Most people think that the starting point for investing is taking money from your bank account, transferring it to your brokerage account, and using it to invest in the stock market. Wrong. The starting point is with retirement accounts and using these accounts to invest. Examples include Roth IRAs and 401ks in the US, SIPs and ISAs in the UK, PRSAs and occupational schemes in Ireland. Depending on where in the world you live, the retirement accounts available to you will differ, but all of these accounts have one thing in common. They all come with tax benefits. For example, for every €100 invested into an Irish retirement account, Irish investors can save up to €40 in tax. That's an automatic 67% return on investment for simply using a retirement account. So find out how much you're permitted to invest into a retirement account each year and max it out. Once that's done, if you still have money left over to invest, then you can use a brokerage account. You'll save thousands in tax by doing so. Number 7, emotional investing. In the words of Benjamin Graham, the investor's chief problem, and even his worst enemy, is likely to be himself. Believe it or not, how your investments perform isn't as important as how you behave as an investor. We've already touched on many examples of this. Investing for the wrong reasons, reckless stock picking, trying to time the market. All of these are behavioral choices that can be avoided. But when it comes to your emotions, things can get tricky. Humans tend to have an emotional attachment to money, and as this article from the Harvard Business Review notes, much of that has to do with the lessons we learn about money at a young age. Most of us don't grow up in a household with a financially savvy parent or sibling, meaning we tend to pick up on some of the bad money habits that have been passed down from generation to generation. One such habit is being overly protective of your money and having an emotional attachment to it. This is counterproductive to successful investing. Why? Because the stock market doesn't just go up in a straight line. There's constant ups and downs, with some ups and downs being more severe than others. So if you have an emotional attachment to your money, it's going to be very difficult to stomach the down periods, and you'll be very tempted to sell. But as we know, over long periods of time, your chances of actually losing money are very slim. So it's all about keeping your emotions in check. Number 8, paying high fees. Like everything else in this world, investing comes at a cost. Not just the cost of the investment itself, but the fees that are charged for buying and owning the investment. Most investors are oblivious to the effects that fees have on their overall overall investment returns. For example, let's say you choose to invest in an S&P 500 index fund. The fund provider will charge you an annual fee for owning the fund, which is expressed as a percentage. How much of an impact do you think an additional 1% fee has on your returns? 1% sounds pretty small, but here's the reality. If we invested $250,000 into an S&P 500 index fund over the next 40 years at an 8% annual return and a 0.5% annual fee, we'd end up with just over $1.6 million. But if an extra 1% is tacked onto that fee, all of a sudden we end up with just over $1.2 million after 40 years, which is 24% lower. So a seemingly small percentage like 1% can have a massive impact on our investment returns, meaning you need to do everything in your power to ensure that you're getting the best bang for your buck. Number 9, not scaling your investments. Any financial advisor will tell you that the earlier you start investing, the larger your returns will be. By starting young, not only will you have more money invested, but you'll also maximize the rewards of compound interest. The longer your money is invested, the greater the effects of compound interest will be, which is ultimately what will get you to the $1 million portfolio. However, as important as it is to start early, what's equally, if not more important, is increasing the size of your investments over time. If we start investing in our 20s, we're likely not earning anything close to what we'll be earning in our 40s or 50s. So it would be foolish to assume that our monthly investment in the market should remain the same every year for 40 years. But that's what many of these investment calculators assume. Instead, when your salary increases, so too should your monthly investment in the market. More money invested equals more compound interest, which equals even larger portfolios. The worst thing you can do when you get a salary increase is to increase your standard of living, i.e. spend more money, because that limits how much money you have available for investing. That's what's known as lifestyle creep, and you should avoid it insofar as possible. Number 10, not having a rainy day fund. We can all have the best intentions in the world for investing as much as we can, as often as we can. But guess what? Life gets in the way. Here's one of my favorite quotes as of late. People change jobs. They move. They make more money. They make less money. They get laid off. They have kids. They have unexpected expenses. They endure health scares. They spend frivolously, and all of the other things that life throws at you. Everyone is going to have good years and bad years depending on their job, geographic location, circumstances, and luck. In other words, life is unpredictable, and so you should always have a sufficient nest egg of cash readily available in the event that you have a sudden and unexpected need for it. You don't want to be in a situation where all of your money is invested and you need to sell your investments in order to cover the cost of unexpected expenses. Why? There will be tax implications if you sell those investments at a gain, or worse yet, you might be forced to sell the investments at a loss. Don't let it happen. Always have enough money in the bank to cover yourself. So that's 10 of the most common investing mistakes that beginners are making. Now that you're aware of them, you might think that you're ready to take on the investing world. Not so fast. You need to manage your expectations for how far investing will take you on your journey to financial independence and how soon it will take you there. This next video will tell you everything you need to know, so make sure that's next up on your watch list. I'll see you over there.